This is Scott Becker with the Becker Private Equity and Business Podcast. One of the questions we had come from a listener is private equity deals for medical practices. This particular one was private equity deals for ophthalmology practices, but we'll talk about medical practices more generally and the structure of these, and 3 to 4 points on the structure. So a typical structure is, let's say a typical practice, mid-size, does $10 million a year in revenues. Now, traditionally, he had almost no income because all the income is distributed to the practice partners in compensation one way or the other. So typically you'd have a $10 million practice that has income that goes to the doctors, but no income at the bottom line for the practice itself. So let's say it's $10 million. When you do a transaction, what happens is you create EBITDA or create income. This means, for example, let's say we want the income to be $1.5 million, and that's going to be create or translate into a purchase price of $1.5 million times, let's say, 8 or 10 times multiple. So now you've got a $12 million value, or at 8 times 1.5 million, you've got a $12 million value. Is at 10 times 1.5, you've got a $15 million value. To create that $1.5 million, the doctors going forward will take a reduction in their income after the deal to create that capital gain. And that's sort of the start of what a transaction looks like. So you've got a situation where the doctors sell the practice for a total valuation of, let's use a simple multiple, 10 times $1.5 million for $15 million. And that's all well and good. Now, the doctors after the deal are making less money, but typically the doctors have not sold the entire practice. They might have sold 2/3 of it. So they've pocketed $10 million. After taxes, at capital gains rates, maybe they've pocketed $7.5 million, something like that between the doctor partners in the practice. And you've got a situation now after the deal, the doctors have some money in their pocket. They still own some equity in the practice, although in this case, 1/3 of it, and their incomes have gone down $1.5 million. After taxes, they've really gone down like $800,000, whatever that number is. So that's the core of this. And this works okay for a doctor who wants to take some cash off the table, who's closer to retirement. That's the one situation that works okay for them. It also works okay if what happens is the income in the practice can be, quote unquote, restored. And people talk about that phrase, can we restore the income, which means how do we build back up income in the practice? And second is where the doctors get what's called that second bite at the apple. And people are familiar with that. Later on, the private equity fund does another transaction. The doctors in the private equity fund sell part of their stake, their ownership in the practice the second time. So there's a couple different things that can make this okay. One is, of course, doctors get dollars off the table to start with. Second is you get to a spot where the physicians are in a situation where their income is restored over time because the businesses run well. And third, if it goes really well, the physicians end up in a spot where they sell it again, where the practice has grown, they sell it again. In the ideal world, the private equity fund is buying more practices at a lower multiple. You put a bunch of them together, they sell at a higher multiple, and everybody makes some money on the back end. Now, this can work well on paper and can work well in practice. What happens, though, in an inflationary period of time and where practice sort of reimbursement is not going higher, you've seen a situation where the incomes are reduced more than expected, bad, and there's been a very difficult time restoring the income, getting income back to where it was, also bad. Then you're stuck with a situation with increasing debt payments and other payments where potentially the value on the back end is slower to come or never comes, so also challenging. So people look at these deals, in the best of all worlds, income is restored, you're able to sell that second part at a bigger multiple, and it's given the doctor some exit situation, some exit cash. In the worst situations, income's not restored, there's not really a second bite at the apple, and it doesn't go all that well. Now, the results of this a long time ago, 10, 20 years ago, were almost disastrously bad. This time around, they've been much more of a mix. A lot of practices have done this and done okay with it. There is some concern that the more recent practice deals may be more challenging, and as interest rates and debt continues to go up and inflation continues to go up and cuts at the margins, this is a much scarier situation. But that's the gist of how people think about these medical practice, private equity transactions. thank you for listening to the Becker Private Equity and Business Podcast. Thank you very much.